Our next guest says the hyperscalers' commitments signal long-term value for nuclear power. Joining us with some picks, Barclays analyst Nicholas Campanella. Good to have you, Nicholas. You know, we talk a lot here, as you might expect lately, about power, which is in many ways seemingly the gating issue to the never ceasing demand for data centers and their compute power. But nuclear, it still seems as though it's a long time. And so I want to start there. Give me the timeline that is reasonable to expect for these SMRs and others to actually begin to operate to provide the needed power.
Well, you're absolutely right, David, and thanks for having me. You know, Meta put out that RFP a couple days ago asking for 1 to 4 gigawatts of new nuclear by 2030. 2030 is absolutely ambitious. You know, we do think that new nuclear, if you started today, would take anywhere from probably 8 to 10 years to build. Now, the utility sector is very well positioned here. Actually, if you think about it, the last nuclear renaissance that we went through, there are plenty of sites that have early site permits or COLs, and that essentially allows us certain Southeast utilities to be better positioned than others to capitalize on this trend if they were to make the commitments. Now, what we've seen out of Meta with that RFP, you know, we think is laying the groundwork for additional large-scale and SMR commitments in 2025.
Yeah. All right. Let's start with the SMR side. I mean, some say, well, the technology is not proven. Others say, of course it is. But either way, it's going to be a while. Just give our viewers some sense of your expectations for the ability of some of these smaller companies to really get these things up and running for the hyperscalers and what the opportunity may be.
Look, it is going to take a lot. But what we are seeing right now, and I'll speak specifically from the regulated utility standpoint, the regulated utilities are more interested at this juncture in doing SMRs, and what you've seen is certain frameworks like the Amazon Dominion MOU, where Amazon would essentially be there working through the construction and then potentially being able to kind of transfer in that first-of-the-kind technology to Dominion. From there, you'd probably see the utilities kind of step in and build these themselves, but I do believe that this is somewhat first-of-a-kind technology risk, and you're going to see that be shouldered to some of the smaller, more speculative companies.
Yeah. All right. As for the larger guys, I mean, if you'd come into this year saying, hey, buy these stocks because there's going to be suddenly everybody's going to realize that there's going to be enormous demand for power, you would have been right. Do you still buy them here, given the move up in so many of these names that has occurred already?
We do agree to still buy them here, and we say that because with the ever-growing demand environment, there will be a mismatch in supply-demand into the late decade. As you see AIs and data centers start to uptick, 2027, 2028, we're not going to have enough resources in this country to supplement that demand. Gas turbines are largely sold out between now and 2029. We already know how much renewables we can kind of bring onto the grid between now and 2026, 2027. We don't really see the ability for those numbers to really go up. At the same time, you've seen virtually every single demand forecast across this country double in the last year. And we're finally seeing regulated utilities start to have earnings revisions from this, like Entergy. So the names that we really like into next year, Entergy, as well as Dominion, who we think can, capitalize this on the regulated side. And then in the IPP side, we still think that these companies are going to benefit from higher power prices. Talon and Constellation specifically are names that we like there.